Every financial decision you make, from your mortgage to your job security, is silently controlled by one market you've probably never heard of. Most people don't even know it exists, and by the time they notice it, the damage is already done. It's not the stock market, it's not crypto, it's something far more important because it quietly runs everything. The bond market isn't exciting. There are no overnight millionaires, no dramatic rallies, and that's precisely why it's so incredibly powerful, because while no one's watching, bond markets are quietly deciding how expensive money will be. You don't see people arguing about treasury yields on social media. Most people never look at it at all. The entire global bond market is worth over $130 trillion, roughly double the size of all stock markets combined. But how does something so massive, yet so unhyped, control everything? How does that work? Because while attention stays on stocks and headlines, the bond market quietly sets the price of money in the background. Every single interest rate you've ever encountered started as a bond yield plus or minus some spread. It isn't just another market, it's where interest rates are actually formed. Your mortgage rate is priced there. Your credit card interest is priced there. The cost of every major loan in the economy traces back to it. Even central banks don't move first anymore. They react. A bond trader in London can move global borrowing costs before any central banker even finishes their morning coffee. Bond markets price the future. Inflation, growth, risk, and policy follows what the market has already decided. When the bond market crashed in 2022, mortgage rates doubled in 8 months, not because the Fed decided it, because bond prices moved first. So, understanding bonds isn't about becoming a trader, it's about understanding how money is really priced and why the economy moves the way it does. A bond is a promise with a price. Someone needs money now. Someone else has it. The borrower says, "Give me $1,000 today. In 10 years, I'll give you that 1,000 back. And every year until then, I'll send you $40 for your patience." That $40 is interest. That's the entire deal. The US government does this. Apple does this. Your city does this when it wants a new bridge but doesn't want to wait for tax money. They're all selling the same thing. Not hope, not growth, not vibes. A contract that says, "Pay me now, I'll pay you later. Here's your cut for waiting." Buying a bond isn't like buying a stock. You're not betting on genius management or the next big idea. You're buying a scheduled apology for not having the money today. And the price of that apology changes constantly. If people start wondering whether the borrower will pay it back, the price drops. If inflation looks like it might eat those future payments, the price drops. If the economy starts making people nervous, the price moves. Nothing dramatic has to happen, just a shift in confidence. You're not buying ownership. You're buying a cash flow someone promised you. And the price of that promise, how much people are willing to pay for it right now, is what quietly sets interest rates across the entire economy. That's it. No complexity, no mystery, just a promise, priced by time, risk, and trust. People borrow money. Businesses borrow money. Governments borrow money too. Not occasionally, constantly. The US government issues new bonds every single week, sometimes every single day. Not because something went wrong, but because money doesn't arrive on a schedule. Tax revenue drips in unevenly, but payroll doesn't wait. Social Security checks go out. Military salaries get paid. Construction crews show up whether tax season is over or not. So there's always a gap between what's coming in and what's going out. That gap gets filled with bonds. Every time the government needs to cover it, the Treasury auctions off a new batch of bonds to whoever is willing to lend at the lowest rate. Pension funds buy them. Foreign central banks buy them. Insurance companies buy them. The government gets cash today. The buyers get a promise of repayment plus interest, and that cycle never stops. The debt isn't a mistake, it's the operating system. National debt isn't one big loan. It's millions of individual bonds, each bond with its own maturity date, its own interest rate, its own repayment schedule. Right now, the US has bonds that mature tomorrow, bonds that mature in 2054, bonds issued last week paying 4.5%, and bonds issued in 2020 paying 0.6%. All of them still active, all of them still owed. They're sitting in portfolios all over the world. A pension fund in California holds $2 billion in 10-year treasuries to pay retirees in 2034. The Japanese government holds over $1 trillion in US bonds as foreign reserves. Your grandmother's savings account? Her bank didn't put that money in a vault, it bought government bonds with it. Each bond is its own contract, a line that says, on this date, you get this amount back, and until then, we'll send you interest every 6 months. So when people say the national debt is $36 trillion, what they really mean is this. There are $36 trillion worth of active promises still out there, each one ticking toward maturity. And here's the part that actually matters. Every single one of those bonds has a price, and that price changes every day. When those prices move, borrowing costs move with them. Debt doesn't just sit there, it accrues interest every single day. Right now, the US government pays over $1 trillion a year just in interest, not paying down the debt, just the cost of having it. That's more than the entire defense budget. Here's why interest rates matter. When rates were at 0.5%, a $1 million bond cost the government $5,000 a year. Same debt, 10 times the annual cost. Now scale that up to trillions. So when a $10 billion bond issued in 2014 at 2% comes due, the government doesn't pay it off, it replaces it. A new $10 billion bond gets issued, at today's rate, maybe 4.5%. The debt amount stays the same, the interest bill doesn't, it jumps. That extra money has to come from somewhere, higher taxes, less spending elsewhere, or issuing even more bonds. The system doesn't break, it just gets more expensive to run. Government bond yields set the baseline for everything else. When the 10-year Treasury yield is at 4%, banks don't offer mortgages at 3%. They offer them at 7%, the Treasury rate plus their margin. Corporate borrowing works the same way. If the government can borrow at 4%, a corporation has to pay 5%, 6%, maybe 8%, depending on how risky it looks. Student loans, car loans, credit cards, all priced the same way, Treasury yield plus a spread. This is why even a small move in bond yields ripples through the entire economy. In 2022, the 10-year Treasury went from 1.5% to 4% in about 8 months. Mortgage rates doubled. The housing market stalled. Companies that had been valued assuming cheap money suddenly looked expensive. Nothing fundamental changed about those businesses. Their products didn't get worse, their revenue didn't vanish, their employees didn't forget how to do their jobs. What changed was the discount rate. Stock prices are based on future cash flows, discounted back to today. When that discount rate jumps from 2% to 5%, the present value of those future profits drops by 30%, 40%, sometimes 50%. That's not a crash, that's arithmetic. The cost of money changed, so everything repriced. Here's why they move first, structurally. Earlier we said bonds price the future. The reason they move first is simple. Bond investors don't get opinions, they get obligations. They're not asking what's happening right now, they're asking what will inflation look like in 6 months? What will the central bank be forced to do next quarter? Who won't be able to roll their debt 2 years from now? And they don't debate those questions. They commit billions of dollars to the answers every single day. That structural pressure is why bond markets move first. In March 2007, nothing looked wrong on the surface. Stocks were at record highs, unemployment was low, financial television was still talking about a Goldilocks economy. But the bond market had already started warning. The yield curve inverted. Short-term rates rose above long-term rates. Bond investors weren't predicting headlines, they were pricing a system that wouldn't be able to refinance itself comfortably. 18 months later, Lehman Brothers collapsed. The same thing happened in early 2020. Before lockdowns, before press conferences, before most people had even heard the word coronavirus, Treasury yields fell from 1.9% to 0.7% in weeks. Bond investors weren't reacting to news, they were pricing an economic shutdown before it arrived. This is why headlines don't lead, they follow. Most governments don't pay debt down, they roll it over. When a $100 billion bond matures, the government doesn't write a $100 billion check, it issues a new $100 billion bond to pay off the old one. The debt doesn't disappear, it gets refinanced at whatever the current interest rate happens to be. That detail matters more than the size of the debt. In 2020, trillions of dollars were refinanced at 0.5 to 1.5% interest. Those bonds are maturing now. They're being replaced with new bonds at 4 to 5%. Same principle, triple the annual interest cost. Today, the U.S. government spends over $1 trillion a year just on interest payments, not building roads, not funding schools, not expanding defense, just servicing past borrowing. As interest costs rise, they take up a larger share of tax revenue. In 2000, interest payments were about 12% of the federal budget. Today, they're over 15% and climbing. Every 1 percentage point increase in the average interest rate adds roughly $350 billion a year to the bill. That isn't a forecast, it isn't a theory. It's the arithmetic of rolling over $36 trillion in debt.
You don't need to trade bonds, but every financial decision you make, your mortgage, your savings rate, your company's ability to hire, runs through the bond market first. When bond yields moved in 2022, your borrowing costs changed before you ever opened a loan application. When Treasury rates dropped in 2020, refinance opportunities appeared before the Fed made a single announcement. The bond market isn't reacting to the economy. It's pricing the future, and everything else adjusts. Interest rates don't fall from the sky. They come from here. If this changed how you see the system, subscribe to Money Unseen. Like this video and turn on notifications if you want to see the next one when it drops. This is Money Unseen.